Hey everyone, welcome to video number 4 discussing net debt. So what is net debt? We've already been over it a little bit at a high level in terms of how it fits into the purchase price calculation. Just to quickly recap, to calculate the headline price, which is kind of your enterprise value of the business, that's the bulk of the purchase price, and it's typically valued in one of two fashions. Typically the first one here, which is a multiple of earnings or EBITDA. The second method is DCF analysis, but typically that one's used more just as a kind of valuation range. We might internally model what we're willing to pay, but at the end of the day, the actual purchase price is typically based on this first one and multiple of earnings. Now, is that the final price that we pay, aka the equity value? No, it's not, because there are some differences in between. The biggest one is typically net debt and cash. We talked about in an earlier video why we adjust for net debt and cash. The reason is you can have two businesses which are identical. For example, they both have 10 million EBITDA, they're both valued at 10 times earnings because they have a similar risk profile, similar industry, etc. So let's just say they're identical businesses in terms of headline price. However, one business has $50 million of debt on its balance sheet, and the other business has $0 of debt on its balance sheet. Obviously, the one with no debt on its balance sheet is going to be worth more than the other one that has a debt on its balance sheet. And the opposite is true for cash. Obviously, a business with $50 million of cash on its, which is identical at the headline price level, if a business has $50 million of cash on its balance sheet versus an identical business which doesn't have any cash on its balance sheet, obviously the one with cash is worth more. So essentially all we do is we calculate what the total dollar value of net debt is in the business and the total, or I should say debt, and the total value of cash in the business. And then the sum of the two, which we call net debt, is the actual one-for-one dollar adjustment to the purchase price. And this can either increase it if it's got a lot of cash in the business or decrease it if it's got a lot of debt in the business. But also, as I mentioned earlier, in most transactions, because it is done on a debt-free, cash-free basis, you typically try and clean up the balance sheet before the sale date. So we try and minimize this debt and cash business and the in the business, and the vendor just tries to sell it with a clean balance sheet. But obviously, in the real world, in practice, it's not always possible to do that, whether it's early exit fees, whether it's the seller pressuring the buyer to keep cash on the balance sheet because it's a tax it's a tax incentive for the seller. The reason is because if we're increasing the purchase price or the equity value of the business because of cash on the business, it means that the seller is getting a higher purchase price, and that's typically any capital gains is taxed on a concessional basis relative to, say, if they paid it out as a dividend. So if they paid it out as a dividend, if they're paying it to themselves, they're going to have to pay the highest marginal tax rate, which could be like 40, even 50%, depending on your jurisdiction and your tax profile. But if you do it through capital gains, for example, in Australia, you get a 50% discount if you've held the business for 12 months, or if it constitutes a small business, you can actually reduce this capital gain down to zero in many cases because of the small business CGT concessions. That's in Australia, but most other jurisdictions worldwide have similar, taxing profiles where capital gains is taxed at a more concessional rate than, say, income. But we'll touch on that in the tax section of this course a little bit later on. So the purpose of this video here is discussing net debt and really going into detail and kind of how do we calculate it? What does it mean? What are the gray areas? Why is it important? How do we do it? How do we check it, etc.? So let's start off with a high level, kind of what are the key concepts around net debt? We know what it is at a high level, right? So net debt is essentially the debt less cash. So it's your debt in the business less your cash. And the net of those two numbers, because one's going to reduce the purchase price, one's going to increase the purchase price, the net of those two numbers will essentially be a single adjustment to the purchase price of the business to get to your equity value. But what does it really mean? Because, when we say debt, we understand what that means, but when you really go into the detail, the devil is in the detail in terms of, arguing what actually constitutes debt. Because if you can argue something is working capital as opposed to debt, it's obviously going to have a significant impact on the purchase price, because as you know from the previous videos is EBITDA impacts the valuation of the business on a multiple. Net debt and cash impact the valuation of the business on a one-to-one basis. And working capital may or may not impact the purchase price because, as I mentioned before, The typical adjustment for working capital is it's any variation to normal net working capital. The exception being, I guess, with small transactions where you're buying very small business on a cash basis. Then in some situations you do have a one-to-one adjustment for working capital, but that's only for very small businesses, and that's because they don't typically account for accrual accounting. So what does it mean? So debt is not just reported debt, and cash is not just reported cash, right? You can't just look at the balance sheet and say, okay, these are their liabilities, let's include those, and we can't just look at the balance sheet and say, these are their assets, let's include those. So we also need to consider what is a debt-like item, and cash also excludes trapped cash. So trapped cash is something which needs to stay in the business because it's part of working capital. So it's really important to look past just the definitions and how it's been accounted for on the balance sheet and actually really understand what each item actually is. And just because it's labeled as something doesn't mean it is, right? So there could be things which aren't labeled as debt on the balance sheet which have the appearance of debt or are debt-like items. And I'll give you some examples of these later on, which we need to include for the purpose of the net debt calculation. And for cash, you might just have a balance of cash, but we say, okay, but you actually need to keep this amount in the tills, for example, because if you don't have money in the tills, how are you supposed to give customers their change when they come in? Now, this definition and the devil in the details becomes really important when you remember that on each side of the transaction, each party has opposing interests, right? If you're the seller, you want to maximize the value of your business. So how do you do that? You try and remove as much of the net debt items as possible. And this is, of course, after we've already discussed, EBITDA. Obviously, the main priority for the seller should try and maximize EBITDA because it gives a multiple on that. But after we get to that and we're starting to negotiate on the little details, they're going to try and get as much of the gray items or the maybe 50-50 items as net debt because it's going to maximize their exit price. On the other hand, the buyer are going to be arguing for as many items to be excluded from debt included into debt because that's going to reduce their purchase price, isn't it? The more items are in debt, the less the equity value is going to be and the less they have to pay for the business. So why is it important? Well, we've kind of covered this already. So transactions are often completed on a debt and cash-free basis. And if they're not, they're adjusted for through net debt. So the completion mechanism with the SPA, or in other words, the sale and purchase agreement, provides for a dollar-to-dollar adjustment to base price for net debt. So remember, net debt is a one-for-one adjustment. EBITDA is a multiple to one adjustment. So you might get 6 times 1. And it's often used as a mechanism to deal with uncertainties on completion, for example, pension liability, and to leave unwanted liabilities with the vendor. So what are the DD considerations that we need to do? And this is where, one of the most value-adding items of DD is in this net debt, right? Because EBITDA, it's fairly straightforward. You look at the P&L, it's really just about understanding the business and arguing it. But net debt is really about understanding accounting, understanding what could constitute debt, and understanding kind of the rules and framework for similar transactions around, what can be included as debt. For example, a tax liability. For example, excessive annual leave and long service leave. Not all of annual leave and long service leave, because that could be argued as working capital, but excessive could be argued as net debt. So that's when those kind of the real arguments start around those kind of 50-50 areas where it could be working capital, could be net debt. And that's when having an accountant to kind of back you up and find things in the detail will really start to pay off and add value. So we mentioned 2 key terms earlier, which is debt-like items and trapped cash. So debt-like items are the items on the balance sheet, right, which are debt, but also which are the fairly obvious ones, like, for example, bank debt and accrued interest, because they're going to be reported as debt in the balance sheet. There's typically not going to be any question around them. The key questions are the ones that have characteristics like debt. And these are items with one-off or non-trading cash outflows, which, if you understand the basics of accounting, that is the definition of a liability. And we'll cover that once we get to the financial reporting videos in this course. So some examples of that: pension liabilities, finance break costs, capital leases, dividends payable, and litigation costs or settlements. So let's have a look at one of these as an example. So maybe dividends payable. So this isn't necessarily going to be recorded as a liability on the balance sheet, right? But if we know that before we settle the business, that in 6 months' time, that we know we're going to have to pay out a dividend, right? Particularly when it's approaching exit, you might have a final dividend which is higher than previously. We need to include that as a debt-like item, because even though it's not on the balance sheet as a liability, like it's not bank debt, it's still going to be a massive outflow of cash from the balance sheet, which the company's going to have to pay for. So we need to include that one. So another example is litigation costs, right? So this could be a contingent liability. So again, another topic we'll cover in the financial reporting section of the videos in later in the course is that contingent liabilities don't necessarily have to be reported on the balance sheet, right? But if we are aware that there's a probability of litigation costs, which we might have to pay out post-settlement, maybe what we could do is calculate the total possible liability and then apportion it based on probability and argue to include that as a debt-like item to reduce the purchase price. Pension liabilities is an interesting one because it is, that's probably more of an American terminology, but in Australia, we obviously have, annual leave and long service leave liabilities. Now, these are typically, and this is a big contention point in any net debt discussion, because annual leave and long service leave are, by definition, net working capital. And we don't adjust for net working capital. Why? Because any business accounting on an accrual basis, the journal, they've been accounting for these provisions over time. So the journal for annual leave provision is, over time, you'll go debit annual leave expense, credit annual leave provision. So you've already got an expense in the P&L, and that's going to be reducing EBITDA, and therefore that's going to be reducing the purchase price of the business by a factor of, let's say, 10 times, depends on the multiple, but let's say 10 times of that EBITDA. So essentially you're saving 10 times the provision expense going through, which is why we don't adjust for it as a net debt item, because it's already in there. So it's working capital in this case. What buyers will argue, however, is that if this is going back to that concept earlier about what is normal, what is outside the norm. If we've got a company, we notice that they've built up unusually, and relative both to other companies and also relative to history, a very, very large annual leave provision or long service leave provision. For example, right now with COVID, no one is taking annual leave at the moment. Then this is, it's going to have a much larger balance historically in the majority of companies. So it would be a valid argument, in my view, to calculate what we think is the average or normal annual leave and long service leave in a company, similar to how we kind of look at net debt and say this is our kind of average normal net working capital. And then anything above that level, we can argue as a buyer that is excessive to net working capital, and we should be adjusting that as a net debt item. So this is just a very short list of examples. There are many, many more that we can go through. But let's go to trapped cash. So remember we said before that, yes, we adjust the business upwards, the purchase price of the business upwards, for any cash left in the business. However, this is exclusive of trapped cash. So what is trapped cash? So this is cash on the balance sheet in the financial statements. First of all, let's start off, what is the definition of cash? It's fairly self-explanatory. And the items it can include is cash at bank. That one's fairly obvious, but some of the other like cash equivalents could be, short-term securities and short-term financial assets. That could be a term deposit, for example. It could be items, but what about items that are classified as cash but not freely available? So these are what we'd call trapped cash. These are cash that needs to be retained in the business for working capital purposes. So examples of this could be cash trapped in overseas jurisdictions. Maybe you've set up an office in Singapore and you've got cash at the bank over there, and you could argue that you need that for the operation over there, that it's expanding. So that might be trapped in the business and you wouldn't adjust for that. Next is cash held in escrow. So that's not actually cash owned by the business because it's part of working capital, right? It's typically used in a situation where maybe you're a real estate agent, you're buying a real estate agent and there's money in the bank held in escrow, but it's not the business's cash. All it is buyers putting that money in escrow, held so no one can touch it. The real estate agent manages it, but that money is used for the purpose of buying property in the name of individuals. That's not actually owned by the company. So we just need to look at any cash balance and say, okay, that's not actually held by the business, that's in escrow. And then finally, bank deposits held as security. So for example, it's a very common practice when you have a lease. So if you've got a company with a large office lease, maybe a large office tower in the city, it's very common for the landlord in those situations to ask for the company to hold a bank deposit as security for the lease. So essentially what that means is they might ask for like 500K, put it in a term deposit. So if anything goes wrong, if there's damages, if you burn it down, destroy, the office, the building, we'll claim that as our own to cover the costs. But the sellers will argue that should be trapped cash and therefore not adjusted as part of the cash at bank. Okay, so why is net debt important in the context of valuation and purchase price? So we've covered this a little bit already. The most important principle is that most valuations are done on a debt and cash-free basis, and the net debt aims to adjust any remaining debt and cash on the business so that it provides a very like-for-like valuation, so that a company is not penalized, which are two companies that are identical are not penalized if one has excess cash or excess debt on the balance sheet, and it's not a penalty to the buyer in those situations. So you're essentially adjusting the purchase price to reflect those. So whether a cash flow model or a price earnings multiple is used to determine the headline price, both exclude net debt from equity value, right? It's not just for a multiple basis. The reason is because regardless of whether you use a cash flow model or a price earnings multiple, all that does is it gets you to enterprise value, right? Enterprise value, by definition, is equity value plus net debt, right? So that's always the case. So the mechanism to adjust for net debt adjustment is in the SPA, and almost every SPA will have an adjustment for net debt in there. But there might be slight nuances transaction to transaction in terms of definitions for net debt, right? Some of these are specifically defined in the sale agreement. The sale agreement or the sale and purchase agreement will also define the mechanism which actually allows for this process of adjustment. And the schedules of the SPA usually include a detailed table of net debt, and that's because it's already been agreed in great detail before this date with both parties arguing and negotiating about what should be included. And then once it's agreed, to get the transaction over the line and to prevent any further arguments, it's all put in a table, put into the sale and purchase agreement, so there can be no disputes. So net debt, therefore, it becomes critical in order to help ensure the transaction is completed at the agreed price. You don't want both parties arguing about it at or before settlement or even after settlement, because it could impact the transaction going through or the success of the transaction integration process after settlement. And in some cases where net debt related adjustments to purchase price are not contemplated in the completion mechanism of the SPA, understanding net debt highlights potential exposures for protection through warranties and indemnities. So there is a correlation between warranties and indemnities and the net debt purchase price adjustment, because, for example, what happens if you have a tax liability that you haven't identified in the business through DD? You're saying in the completion mechanism, you say, okay, well, if we do find any, if any do come up, it'll be adjusted through net debt. But if it's adjusted through net debt, then you probably don't have a claim through warranties and indemnities because you're already getting a reduction in purchase price through the net debt adjustment. All right, so just something to keep in mind, the interaction between warranties, indemnities, and net debt. And then finally, just around financing. So I mentioned before, yes, transactions are done on a debt-free, cash-free basis, but in practice, this isn't always the case, simply because, if you've got a large loan in the business, you might have early penalty payments. You might have to repay, a couple percentage of the total loan. You might have to pay interest fees and so forth. So rather than going through that process, which would probably hurt both the buyer and the seller and buyer in most cases will just agree, look, let's just leave the debt in there, and it'll just be adjusted out through the mechanism in the SPA. So in a leveraged transaction, the net debt funding usually comes from a financial institution, right? So your CBAs, Westpacs, your Macquarie's, your Bank of America, etc. So the net debt definition in the SPA therefore becomes critical because the lender defines debt in the senior credit arrangement. The lender's terms, including covenants, are based on the definition of the SCA. And if the definition of net debt is not aligned between SPA and SCA, the buyer may potentially breach the covenants or coverage ratios. So it's just very important when you are deleveraging the business as part of the purchase price, you don't actually breach any covenants and coverage ratios, which we'll discuss a little bit later in these videos. But breaching what covenants are essentially is the bank, when it lends money to a company, to protect itself, will put inside these rules, including how much money you can borrow, what your EBITDA needs to be, right? So that you don't go and over leverage, go bankrupt, and the bank can't collect its money anymore. So it puts these rules in place, and that might also be around kind of whether you can repay it, who can acquire the business, and does the bank need to be approved. The bank will have charge over certain assets in the business, etc. So it's just important to keep in mind when you are deleveraging the business for the purpose of you buying a business on a debt-free, cash-free basis. Just keep in mind, the impact on potential covenants or coverage. Okay, so let's look at a practical example of a company. We've got two examples here. And one, what is the purchase price on what is the impact on the purchase price by correctly and incorrectly identifying net debt items in the business? So in this example, we've got the same business, but in just two different situations. One where company one has appointed very high quality financial due diligence, and they've been able to identify. The obvious one is reported debt on the balance sheet, right? It's your debt to the bank. That one's pretty easy. Anyone without an advisor could identify these. But in this example one, they've hired, let's say, PwC this time. And PwC has come in and said, well, you should argue to include pension liability because, even though, I think if you're Australian, think about it as, your annual leave or long service leave. We think you should include this because we think it's excessive to average working capital and due to COVID, and we think you should include this because eventually you're going to have to pay it out, and otherwise, you're essentially paying a high purchase price, and you're going to have to pay this out later as well, which could be argued to be part of the purchase price as well. On top of that, your legal DD has uncovered a potential litigation settlement cost, which wasn't disclosed. So you have now used that as ammunition to argue as part of your negotiation, well, we need to include this as part of a net debt adjustment because when in 1 to 2 years post-acquisition we have to pay this out, that will be on top of the high purchase price we're paying. So we think that these should be included as part of net debt adjustments, which will reduce our enterprise value and therefore to get to our lower equity value of 580. So essentially it's our EV of 1,000 less the reported debt of 300. So we're now at 700 less 70, right? So we're now at 630 less the 50, we're now at 580 equity value. Example 2 is they didn't appoint good due diligence advisors. So they didn't appoint PwC to identify this pension liability, and they didn't identify through their legal DD because they wanted to save 50K on legal costs. They didn't identify this litigation settlement cost. So now what's happened is the final agreed equity price is now only 700 because they've only included the reported debt as a net debt adjustment. So two situations, same company, exact same company. But in example 1, they've negotiated down to 580 equity value, but example 2, they've negotiated to 700 equity value. Now let's consider after the fact. So after we've actually purchased the business and in 1 to 2 years down the track, when those actual obligations arise and how much we've had to pay, right? So in the first situation where we were able to negotiate a lower equity value for the business because we were able to identify, we still have to pay for the pension liability litigation. So we know that we have to refinance the debt. So we're essentially going to pay down the debt over time. So the 580, which we paid for the upfront purchase price of the business, over time we pay down the debt. So we paid another $300,000 or million, however you want to look at it. Pension and litigation. So this risk, which was we only knew about these because of our due diligence, those arose in year 2 post-acquisition, and we had to pay out for those as well, either through the company's own money or through an additional equity injection from the owner. So that means over time, the amount of money that the company has actually paid over time only ended up being $1,000. And it's very important, as you can see, when done correctly, the net debt adjustment results in, over a long period of time, the purchase price correctly reflecting the enterprise of the business. And that's how it should be, because at the end of the day, the whole purpose of the net debt adjustment is just to make sure that two businesses which are identical are not penalized because one has, a certain debt level in the business, a certain level of cash in the business. When done correctly, it should adjust out correctly through the mechanism. However, if you don't do it correctly, you don't identify all the risks, you can end up paying a lot more for a business. So in this example, we ended up paying, we agreed 700 million, let's say million equity value for this business. We had to refinance the debt, so we paid that down over time. So we're now at $1,000 paid out. But also these pension and litigation costs arose, which we didn't foresee, and we had to pay those out as well. So we probably can't claim these under warranties and indemnities because they're just costs that have arisen. If it's a litigation that was, the vendor was aware of at the time and they didn't disclose it as part of DD and our DD findings didn't find it, then we might be able to claim it as part of warranty indemnity section of the sale and purchase agreement. But as I mentioned before, it really comes down to is the amount material, because often those claims need to be above a certain amount. B, can you actually collect the money, right? Is the vendor contactable? Have they flown off to South America? Have they gone bankrupt? Maybe they don't have any assets. Maybe they've done asset protection mechanisms, like transferred all the money into a trust, so there's actually no money to collect. Or maybe you actually lose in court and actually, can't actually claim it. Or the third situation is you're still working in the business with the previous sellers, for example, the joint venture arrangement. Selling, you have to sue them essentially, unless you've got warranty indemnity insurance. You have to sue them. That's going to really ruin your working relationship. So some companies might just say, well, it's probably not worth it to do that. So in my mind, this company has essentially paid $120,000 higher for the business than they should have because they didn't do appropriate due diligence. So that's just a good example as to kind of why it is important to really understand the due diligence mechanism and the net debt mechanism, and really do your due diligence in the process. Okay, so let's talk about what to consider in due diligence when you're looking at when you're looking at net debt. So some of the kind of areas to look at, I guess, first of all, ask yourself the questions: what kind of items could be considered as debt? So really do a print off of the TB, look at every single account, look at transaction level as well, in case it's been coded to the wrong account, and so forth. And just really ask yourself at a high level, not just looking at the labels on the balance sheet. Ask yourself, would this be considered as a debt-like item? So look for any balances in the nature of borrowings. Look for debt factoring, promissory notes, or other receivables financing. Look for guarantees, supply finance letters of credit, which I note aren't always going to be on the balance sheet, right? But have a look at those. Look at break costs and early repayment penalties. Again, most companies probably wouldn't have accounted for those, so you actually might need to dig around through the agreements to pull those out. Look at capital commitments. So if this company has actually made an agreement to another company saying, I will commit, $20 million, typically in capital commitments, you only have to provide that money when they're called upon by the company they've provided that commitment to. So the company might still have $20 million of cash on its balance sheet, but then you find out after due diligence that they've signed this agreement with another company that, to commit over a period of, 5 years or so, $20 million. That should probably be a liability to pick up. So that's something that you want your legal DD to really look at. Trapped cash. So we want to look at, any signing restrictions, withholding tax. Although if you're the buyer, you probably want to spend more time on the net debt side rather than trapped cash, because obviously this is going to go against your favored position. Whereas if you're a seller, you probably want to focus more on identifying any trapped cash items. You want to look for off-balance sheet liabilities, for example, operating leases, anything which isn't reflected on the balance sheet, which could be constituted as a liability. Are there any cash balances which are considered as working capital? So that's probably something that a seller would want to do rather than a buyer. And then are there any cash restrictions, trapped deposits, advanced payments? So a lot of these you really want to consult with legal advisors, because it's not going to show up on the accounting. It's going to show up in material contracts, and really looking through the terms and conditions of any agreements that the seller company has. So that's something for the lawyers rather than the accountants. So here's some just very specific examples of items that are debt and cash. There are going to be many other examples that we could include. This is not exclusive. So loans, overdrafts, bank borrowings, loan notes, intragroup, and other financing balances, pensions, bonuses. This is bonus provisions, not expenses. Deferred income, transaction costs, operating leases, capital contributions, other provisions. So the next step when you're looking at your kind of balance sheet and you've kind of got a list of all your debt-like items is to try and categorize each item in the balance sheet into one of these categories. Now, you might have seen a due diligence paper before, like an FDD pack from one of the big four or other providers. And when they present the balance sheet, they typically don't do it as you've kind of learned in accounting, which is, you do your current assets, you do your non-current assets, then your total assets, then you do your current liabilities, non-current liabilities, total liabilities, and you get to equity, right? That's the traditional way in the financial statements to report the balance sheet. That's not a lot of value here. So how we actually present it in FDD report and in M&A is we reallocate the balance sheet and we present it into these categories here. So first of all, we categorize everything into net debt, so breaking it down by debt and cash. And then we look at provisions and accruals, right? The reason we separate this out one occasionally from net debt is because these are the gray areas. These are the ones which could be argued either as working capital or net debt. So this is kind of like the gray area. You want to separate it as a bucket so you can just have the discussions around those specific items and not have it mixed in with the rest of the obvious net debt items. Then the next category is working capital. Working capital is anything that's converted to cash within the operating cycle, usually short-term recurring operating items. And then you might have a category for infrastructure, which might be your PP&E or your buildings, right? Because this is an important item which we haven't actually covered yet. You might have had the question, how do we treat a building or plant and equipment? This is actually considered, just like working capital, to be considered to be part of enterprise value. So if you're paying for enterprise value, you should be getting working capital and infrastructure. You do adjust for net debt and other provisions, but these just come with the business because you are expected to get some value when you're paying for that enterprise value. Like, what do you think you're getting with that money? You need to be getting the aspects of the business which is consistent with other businesses which may be identical, which are the key drivers of actually driving that EBITDA, right? So the working capital is required to be part of the underlying business model which generates that EBITDA. The infrastructure, for example, your plant, your machinery, your buildings that you own, the facilities that you operate in, that is also required to be able to generate the EBITDA, which comes with the enterprise value. So that's why they're included. And just to recap, I know I've said this quite a few times, but the reason we do adjust for net debt is that you might have the same business, which is identical. Like they might have two, car dealerships. In that case, the cars are probably the working capital. The infrastructure might be the building they operate in. Both of those two identical car dealerships, they both have the same working capital and infrastructure, but they don't necessarily have the same net debt because that's going to be dependent on the actual financing position of that particular company, which is why we adjust for that. So hopefully that makes sense. Now, once you do that, you also kind of want to view it from two lenses as well. Number one is all the balance sheet items, right? Everything that's on the balance sheet reported by the seller. And the other one is any off-balance sheet items. So you might have a separate category down below. So it's essentially a 2x5 kind of matrix. Off-balance sheet is essentially anything which either your accountant has found or your lawyer has found in terms of obligations, commitments, contingent liabilities, things like that, which aren't on the balance sheet, but still should be in one of these categories. So a couple of principles there. Number one, you really grill the balance sheet, right? So really understand each and every line item, look at the detail, ask yourself the question, look beyond just the label and really ask yourself the question, what is this? What is the true nature of this item? So really grill it. Look everywhere, look at the detail, question, compare, use benchmarks. Number two is allocate the balances, right? So that's what we've done above, and what I've just walked you through is to actually put it into one of those categories in the 2x5 matrix above. And then consider off-balance sheet items. So this one's often overlooked, and understandably so, because, it's hard to find, and you may not find it, right? Because if it's not reported on the balance sheet by the seller, then how are you supposed to find it? It is important to do the analysis in case you find something, but chances are in most deals you probably won't find any kind of material off-balance sheet items. But it's important to check. So again, probably repeating myself a little bit here, but again, this really just helps you understand the difference as to what might constitute a debt-like item. And you really want to look, so again, keep in mind the motivations of both the buyer and seller. So the purchaser want to look as widely as possible for these items. The seller wants to keep it as narrow as possible, and vice versa for cash. The purchaser want to keep the definition of cash as narrow as possible because that's going to increase the purchase price, and the seller is going to do the opposite, right? So it's important to acknowledge those dynamics, just so you're aware of kind of any biases and the impact that might have on what's actually reported and negotiated, etc. So what are some, just like we went through this with EBITDA, what are some common limitations of net debt? So the first one is definitions may be judgmental. So it may depend more on commercial than accounting interpretation. So it's, the definitions of what we're dealing with in debt are down to interpretation. So as I mentioned before, it's not necessarily just what the label is on the balance sheet, but really understanding how does the business use this? Because the vendor and purchase might have a different perspective on the same item as to whether that's a net debt item or a working capital item. An example is a purchaser may consider advances from customers as debt, like given that the vendor has received benefit of the cash advances in the period of ownership, right? While the purchaser will have to incur the cost to provide the services relating to that advance. So the purchaser is going to say, that's a liability, I'm going to have to pay that in future. The seller, on the other hand, is going to say, well, no, that's recurring part of the business, and therefore that fits in the definition of working capital. It's recurring, it's converted to cash on a regular basis. So that's one example about interpretation of what it actually is and how it actually fits in with the business. And then also just keeping in mind the biases of both sides in terms of they'll say what they want to get what they want. Next is the buyer-seller may have a significant influence. So from a purchase perspective, it's, as I mentioned before, just understanding those biases, it's preferable to find debt as widely as possible and cash as narrowly as possible to maximize debt and hence lower the overall purchase price. However, this approach needs to be balanced with the competitive tension of the deal, as a purchaser may lose the deal if they're too aggressive on what they include in net debt. This is a really important point, especially if you're dealing with an auction process with multiple other bidders. At the end of the day, once you get through your EBITDA, which is probably the most important thing, as I keep saying, because EBITDA is valued on a multiple, right? 10 times EBITDA, for example, whereas net debt is a 1-for-1. So yes, you want to act in the company's best interest, and if you're a seller, that's to maximize the purchase price, and if you're a buyer, you want to lower your purchase price, right? Get the best deal for your money. But at the end of the day, if you're negotiating on a 1-for-1 adjustment and you're actually losing the status as preferred buyer, or you piss off the other side to the extent that you lose the deal, then your priorities are wrong in some cases. Yes, if you're paying too much, walk away. But if you're trying to just focus on the nuts and bolts because you think you're right, rather than thinking bigger picture about winning the deal, just reevaluate your priorities and asking, am I focusing on it? Sometimes we do have to concede some items to get the deal done. Next is lack of clarity on whether certain items will materialize into cash outflows. So there's often uncertainty over whether some debt-like items will crystallize into cash outflow, how much and when. So a good example of that is litigation. So I gave the example before, we went off balance sheet, looked at some contingent liabilities, we noticed risk of litigation, but let's say there's only a 50% chance that it actually occurs. Well, the first risk is, how do you know that that probability percentage is right? And then do we actually adjust for it in the net debt? And we also need to consider, do we even include this as a net debt item if we're covered under SPA warranties? So for example, if we were to include 50% in the net debt adjustment, would we be in a worse position than if we got hit by the risk and then we just claimed it under warranties and indemnities? I think you probably would be better off, because the reasons I said earlier about whether you can actually claim it, plus if you're aware of it in DD, you probably can't claim it through warranties and indemnities anyway, unless you have specific warranties and indemnities insurance, or you've negotiated a specific, for example, a tax provision insurance. But yeah, just something to keep in mind. And that's kind of covered by the second point as well, just noting that, if you are impacted and you're not adjusted through net debt and you want to claim through warranties and indemnities, it's through the court process. So there's no certainty that those claims will be successful or that you'll reach a conclusion. So if the risk is high, then a price adjustment is probably more certainty and more appropriate for you. Next is double counting. So we just need to be careful that there's no double counting of net debt adjustments where management's business plan already incorporate one-off non-trading cash flows. So I think it is relevant, and again, it comes down to your understanding of accounting. Kind of, if we make an adjustment, how does it impact the rest of it? So, for example, I gave you the example before about why we didn't adjust for the annual leave and long service leave provision in the business, why that's working capital, because if it's an accrual accounting business, then the journal's already in there in the P&L. So you've already gone debit, annual leave expense, credit, annual leave provision. So you've already adjusted off that already. Okay, so let's look at some actual practical examples from the real world. So in this case, let's look at an example around cash. So we've got a definition here. So we've looked at this business. It's operating international. It's an international business. Now, they've defined their cash as shown by the nominal ledgers of each member of the group at the completion date, but excluding cash, being notes or coins in tills and transit. Why? Because that's working capital between the properties and the relevant bank account of the vendor group. And number 2, cash held on deposit in Russia, right? Because that's cash that's trapped. And then 3, cash held in respect of customer advance payments. So if I just look at the first kind of call out box over here. So in this example, so cash considered as working capital is removed, which is fair enough. And also trapped and restricted cash is removed as well. The restricted cash is, of course, any money on deposit or in escrow. So a couple of notes down here. So number 1, cash seems fairly straightforward on the surface, but then you start getting into some issues like the ones above where what is in escrow, what is actually working capital cash to be excluded. So the cash balance is defined as being that per the nominal ledgers of the group at the completion date. It is not therefore the cash in the group bank accounts. This could be very different. So how they've accounted for the nominal ledgers could be different to how they've actually allocated the cash amount in the bank. Some of the money in the cash in the bank may include working capital, for example, whereas nominal ledgers might include, cash in transit, for example. So next item, cash in tills and in transit is excluded on the basis that is not freely available cash, i.e. in a retail business, there's always going to be a certain amount of cash in the tills and such. This is a working capital item. Yep, so we've covered off that already. And then finally, trapped cash is excluded. So this relates to cash items that are not readily usable by the group. So for example, deposits, foreign exchange restrictions, withholding taxes, or in this case, deposits or escrow. So let's look at another example, which is external debt. So in this case, we've got an excerpt from the SPA, how they've defined net or external debt. So all borrowings as shown in the nominal ledgers of each member of the group, and indebtedness in the nature of borrowings, including by way of acceptance credits, discounting or similar facilities, finance leases, loan stocks, bonds, debentures, notes, debt or inventory financing, debt factoring arrangement or sale and leaseback arrangements, overdrafts or any other arrangement in the purpose of which is to raise money, owed to any banking, financial, acceptance, credit lending or other similar institutional organization, and any institutional investor which in each case is not a member of the vendor group. So a very long definition, but I think that's really important for any SPA because, when we are negotiating these things, the broader the definition is, the less specific the definition is, the easier it is for both parties to find loopholes, to negotiate, and the more specific the definition is, it makes it very hard to kind of push back, to argue with things, because if it's all written down there, how can you argue? It specifically says loan stocks, it specifically says debentures, so how can you argue that those things wouldn't be included? So after you do your DD, you need to agree with the other party. When you're party in negotiation, they need to be super specific and write down every single thing that you've identified, plus that you're aware of or concerned with, write them down so they're covered and addressed. And then the second part of the definition is any early termination, prepayment, or other break costs or penalties. So these are ones that they've obviously negotiated, they've identified as part of their due diligence. In respect of such amounts, calculated for the avoidance of doubt on the later of the date on which such costs are incurred on completion date, and interest paid or accrued on such amounts up until completion. So in this example over here, they've actually gone and included commitments and accrued interest, which is an unusual one because it means they would have actually, done the due diligence, identified the potential risk there, being able to negotiate with the other party, and negotiate to include that in the sale and purchase agreement. So here's another kind of more specific example. We've got our kind of basic net debt over here, and then we've got our potential adjustments, which is the ones that we've kind of identified in DD as the maybe ones. So we'll come to the other party, we'll present all of these ones and say we want to include these, and then we might have another category down below which is even more subjective, right? So you just have different kind of buckets which we're high conviction on these, low conviction on these, but we're willing to accept maybe half of them to get the deal over the line, something like that. So this is our kind of mechanism for dealing with uncertainty, and we kind of, as I said, we put them in buckets based on how certain we are in each category that we're going to get it across the line. It's just a good mechanism for going through a negotiation process. Makes it simple, very clear. Just saying, yep, these are the ones we're certain of. These are the ones that we maybe form the basis of negotiation. And similar to kind of how we went through this table on an earlier slide around EBITDA and valuation, why it's so important to get EBITDA right. Why is it so important to get your net debt valuation right? Just to quickly recap what we've been through in this video. So there's probably three lenses we're going to look at. Number one is from a valuation perspective, number two is from a purchase price, and number three is from a financing perspective. So getting it right from a valuation perspective. So, gain an informed and detailed picture of debt-like items and cash exclusions, providing a sound basis for the valuation of the business. So, how is valuation different from purchase price? Well, value is what the business is, the value of the business, right? And purchase price is what you pay. So sometimes there can be a difference between the two. If the value is higher than the purchase price, you're getting a good deal. And if it's vice versa, then maybe you're not getting a good deal. So why is it important for the purchase price? Well, it's important that based on your due diligence, you have a very robust schedule of net debt prepared. This allows you to have a very effective, clear, and low disagreement mechanism in an SPA, including definition, closing mechanism, etc. And it ensures that you're paying the right price for the transaction. So you know that you're actually paying the right price relative to the valuation that you've come up with originally. And I'd like to kind of bring you back to that earlier slide where we went through those two examples, example one and example two, where we had hired high quality due diligence versus not hiring high quality due diligence. And the difference was not being able to pick up on those kind of contingent liability and pension liabilities, which resulted in one scenario where we overpaid for the business and another where we ended up paying the enterprise value over time, which is how it's meant to work. And the final perspective is just around financing. So, making sure that net debt is properly identified and funded, right? Because if you don't identify the correct liability, for example, you might have a $100 million contingent liability on the balance sheet, you're going to have to pay for that over time. So you need to take it out of your upfront purchase price so you can pay for it. And if you don't, you have to find another funding source for it. And that can be particularly tricky when you've already got the business highly over leveraged. Maybe you don't have any other funding sources. It could be a means of actually bankrupting you. And also the implications in terms of covenants, etc. Because if you do need to take out additional net debt as a result of that, you need to take into account your covenants, including around leverage ratios. Okay, so that's the end of the chapter talking about net debt. I hopefully you understand the importance now as to why it's so important to get it right and how there are so many grey areas. It is actually very difficult to get right and very easy to get wrong, or for the seller or buyer to mislead one another, particularly given we now know they have different competing interests and often negotiate on that basis as well. So in the next video, we're just going to be talking about working capital, which is the next kind of lever of adjusting a purchase price.